Let's talk about one of the biggest promises a company can make to its employees, a pension. Now, this isn't just a nice little bonus, it's a huge financial commitment. Today, we're going to pull back the curtain on how accountants try to slap a number on that promise and what that number can tell you about a company's health.
Right, so think about this for a second. This is the real challenge here. We're talking about putting a price tag on money that might not be paid out for decades to people who might leave the company, with investment returns that, let's be honest, are a total mystery. So how in the world do you account for that? It's a massive, fascinating puzzle. Okay, so before we dive into the weeds with the numbers, you've got to understand that not all pension promises are the same, not even close. The biggest difference boils down to a really simple question. Who's on the hook if the investments go south? And this really shows you that crucial split. On one side, you've got a defined contribution plan, like a 401k. The company's part is pretty simple. They put a certain amount of cash into your account, and after that, hey, it's on you. If the market does great, you're golden. If it tanks, well, that's your risk. But with a defined benefit plan, whoa, that's a whole different ballgame. The company isn't just promising to contribute, they're promising a specific result, like, we will pay you $1,500 a month for the rest of your life. The investment risk is completely on them. They have to deliver, no matter what the stock market does. And yeah, because all that risk is on the company's shoulders, accounting for that defined benefit plan is where everything gets super complicated and super important. So that's what we're going to focus on. So, how does this gigantic, decades-long promise actually show up on a company's financial statements today? Well, it all boils down to a pretty simple comparison, which I like to think of as the pension piggy bank versus the giant IOU. To figure out just how big that IOU is, companies can't just throw a dart at a board. Nope. They bring in these specialists called actuaries. These are basically financial fortune tellers, math whizzes, who use a ton of statistics to predict the future. They're looking at things like how long people will live, what their final salaries will be, all to calculate the cost of those promises in today's dollars. Now, even these actuaries have a few different ways to slice and dice this number. You can see here how the IOU gets bigger and includes more stuff as you move from left to right. But to keep everyone on the up and up, accounting rules basically say you've got to use the biggest, most cautious number. That's the one on the far right, the defined benefit obligation. It's the whole shebang. It includes all employees and even guesses at their future raises, making it the most complete and usually the largest version of that promise. Okay, so you've got this massive IOU. Now, what about the money to pay for it? Well, to cover that promise, the company sets money aside in a special fund. This is our piggy bank. The official accounting term for it is plan assets. And it's basically a big pot of investments, stocks, bonds, you name it, that's supposed to grow over time. So, you can probably see where this is going, right? You've got the size of the promise, the IOU, and you've got the size of the savings, the piggy bank. The big, multi-billion-dollar question is, do they match up? And the answer gives you one of two situations. Pretty simple, really. If that giant IOU is bigger than what's in the piggy bank, the company has a pension deficit. It means they've promised more than they currently have saved up. On the flip side, if the piggy bank is bigger than the IOU, that's a surplus. They're ahead of the game. And that simple comparison, that deficit or surplus, has a name. It's called the funded status. You should really think of it as the live scorecard for how well a company is keeping its pension promise. But of course, that scorecard isn't frozen in time. It's constantly changing. Every single year, a whole bunch of things happen that make both the piggy bank and the IOU bigger or smaller. The total change in cost each year really boils down to three key ingredients you see here. You've got service cost, net interest, and remeasurements. A couple of these are pretty predictable and affect the company's profits, but that third one, that one's a bit of a wild card. Let's break that down real quick. First up, service cost. This one's easy. It's just the value of the new pension promises that employees earned by working for the company this year. It's a regular cost of business, so it hits the company's bottom line, their net income. Next, there's net interest. This is the effective time just ticking by. The big IOU gets a little bigger just because you're 1 year closer to having to pay it. But at the same time, the piggy bank is hopefully earning some investment returns. The difference between those two also hits net income. And finally, you have the wild one, remeasurements. This is all the stuff you just can't predict. The stock market goes on a wild ride, or those actuaries change their minds about how long people are going to live. Because these surprises can be massive, they don't get thrown into net income. Instead, they're parked in a separate area called Other Comprehensive Income, which basically keeps these huge swings from making the company's profits look totally chaotic from year to year.
Okay, I know that's a whole lot of accounting jargon, but what does it actually mean for people in the real world? Why should you care about any of this stuff?
Well, if you're an employee, it's all about security. A big and growing deficit is a red flag. It could mean your future benefits aren't as safe as you thought. For investors, you need to see that pension deficit for what it is. It's a debt, a really big one that can drag down the company's stock price. And for the company itself, man, it is this incredible, high-stakes balancing act between honoring the promises made to its people and the financial reality of staying in business. So we'll end on this thought. A pension is one of the biggest, most obvious promises a company makes. But seeing just how complicated it is to account for it, well, it kind of makes you wonder, doesn't it? What other promises, what other IOUs might be hiding in plain sight in those financial statements?